Welcome to Breaking News to Trading Moves. I want you to just imagine for a second generating the entire annual operating budget of New York City.
Oh, wow. That's a massive comparison.
Right. Like literally every firefighter, every public school teacher, every bridge repair, every single pothole fixed in the city in just 90 days.
Yeah, which is just staggering to even conceptualize.
It is,
Yes.
but that is exactly what JPMorgan Chase just accomplished. They posted a record quarterly profit of $21.2 billion. And this staggering number was supported by an 86% jump in equity trading revenue. Plus, rapidly rising investment banking fees stemming from a recovery in mergers, acquisitions, initial public offerings, and corporate financing.
Yeah, to put that into a daily perspective, we are talking about roughly $235 million in pure profit cleared every single day for 3 months straight.
Every single day. That's just wild.
It really is. And when you see a number that massive, you kind of have to trace it backward. Like every cent of that $21.2 billion represents a fraction of a penny taken from millions of separate actions.
Right. It's the result of thousands of moving parts perfectly aligning, in a highly active market environment.
Exactly.
So our exact mission today is to look directly at this headline and break down the specific winners and losers across the financial sector based on this report.
Yeah, because not everyone wins in this environment.
Exactly. We want to understand who benefits from this specific setup and who gets left behind. And as we do this, I really want you to think about the mechanics of where that exact capital originates in the market. Because, it doesn't just materialize out of thin air.
No, absolutely not.
It's extracted step by step from human activity, from corporate strategy, and these really complex transactions.
That's actually the perfect way to frame it. The fees generated from underwriting a new public offering or executing massive block trades for institutional clients, those are the literal building blocks of that $21.2 billion profit.
Which brings us right to our first group of clear winners from this report, which are the large investment banks.
Right.
We're talking about JPMorgan Chase, ticker JPM, Goldman Sachs, ticker GS, and Morgan Stanley, ticker MS.
Yeah, these large investment banks, they are the primary engines of Wall Street. They are positioned perfectly to capture revenue directly from advisory work, from underwriting, and obviously trading.
So let's look at the actual mechanics of why that is.
Sure. So when a major corporation decides it wants to acquire a competitor, they don't just, shake hands and wire the funds from a checking account.
Right, if only were that simple.
Yeah, exactly. They hire an investment bank to value the target company, to structure the really complex financing required, and to basically navigate all the regulatory hurdles. And the bank collects a really substantial fee just for that advisory work alone.
Right. And it's not just mergers either, is it? It's the IPO process, too.
Exactly. When a private company decides to go public through an IPO, the investment bank underwrites that entire offering. They don't just offer advice, they actively price the shares.
Right.
Yeah, they market them to massive institutional investors during a roadshow, and they often guarantee a certain amount of capital for the issuing company.
So they take on actual risk.
They absolutely take on risk. And because they take on that risk, every single step of that process commands a premium fee.
It reminds me of real estate agents, but on a massive corporate scale.
Oh, that's a good analogy.
Right, because when an agent helps you sell a house, they collect a percentage on that sale.
Mm-hmm.
They don't actually own the properties themselves, right? But they facilitate the transaction and take their cut from the activity.
Yeah, exactly.
These large banks are doing the exact same thing. But wait, here is my question for you on this.
Okay, go ahead.
Since JPMorgan Chase had a record quarter, does that guarantee that Goldman Sachs, ticker GS, and Morgan Stanley, ticker MS, will see the exact same results? Or, are there nuances in their business models that we are maybe missing here?
Well, that is a really vital question. And the short answer is no, it doesn't guarantee the exact same results.
It doesn't.
No, not at all. There are distinct nuances in their business models. While JPMorgan Chase's quarter is certainly a positive read-through for the others, it bodes well their structures differ entirely.
Okay, how so?
Well, JPMorgan Chase has a massive consumer banking arm. They issue credit cards, they write residential mortgages, and they have retail branches on thousands of corners across the country.
Yeah, you see them everywhere.
Exactly. And that massive consumer base provides a very steady, predictable baseline of revenue.
Ah, I see. So they have a built-in shock absorber, essentially.
Spot on. But Goldman Sachs, ticker GS, and Morgan Stanley, ticker MS, they operate quite differently. They are much more reliant on pure investment banking, trading floors, and wealth
So
management.
they don't have that cushion.
Right. Because they lack that giant consumer deposit base, their quarterly results are extremely sensitive to the exact types of deal-making and trading environments we are discussing today.
Wow.
Yeah, if the recovery in mergers and IPOs sustains itself, their shares stand to benefit immensely,
Hmm.
perhaps even more directly from the capital markets activity than a broader commercial bank would.
That makes perfect sense. They are highly leveraged to the specific activity of the market itself.
Precisely.
Now, if JP Morgan and Goldman are arranging billions of dollars in new IPOs, where do those newly minted shares actually trade? Which, brings us to our second group of winners, exchanges and market infrastructure.
Yes, a very compelling group.
Right, and the companies we are looking at here are CME Group, ticker CME, Intercontinental Exchange, ticker ICE, NASDAQ, ticker NDAQ, and Cboe Global Markets, ticker CBOE.
Yeah, and this group is fascinating because they operate the actual digital venues where all this financial activity takes place.
The actual pipes of the market.
Exactly, the infrastructure.
Yeah.
Exchange operators benefit directly when volatility, trading volumes, and hedging activity rise.
It doesn't matter if the market is up or down, right?
Not at all. It does not matter to the exchange whether a stock goes up or down. What matters entirely is how much volume is flowing through their servers. More transactions mean higher clearing fees, more data sold to algorithmic traders, and more execution revenue.
Let's break down how specific activities benefit different exchanges within that group. The report mentioned a recovery in IPO activity, right?
Yes, it did.
So I understand lifting fees, obviously. But how does an exchange like NASDAQ, ticker NDAQ, turn a single IPO into a long-term profit engine?
Well, a stronger IPO market is essentially the lifeblood for NASDAQ. When a company goes public, they have to choose an exchange to list their shares on.
Right.
And NASDAQ competes fiercely to win those listings. When they secure an IPO, they get the initial listing fee, sure, but the real prize is the ongoing ecosystem.
What do you mean by ecosystem?
They capture the daily trading volume for that newly public stock forever, basically, which generates constant transaction fees. And on top of that, they sell the real-time pricing data of that stock to algorithmic traders.
Wait, so algorithmic traders are paying just for the data feeds, like just to see the prices?
Oh, they're paying an absolute premium for it. High-frequency trading firms will literally pay NASDAQ for the right to place their computer servers inside the exact same data center as NASDAQ's matching engine.
No way.
Yes. It's a process called co-location. It allows the trading firms to shave fractions of a microsecond off their trade times. And NASDAQ monetizes all of that infrastructure.
That is wild.
Yeah, it's a recurring revenue stream that starts entirely with the strong IPO market.
So they are basically charging rent for server space. That's unbelievable.
It is a very lucrative model.
Okay, now what about the others, like CME Group, tickers CME, and Cboe Global Markets, ticker CBOE? Because I know their business models are a bit different from a traditional stock exchange.
Yeah, their models rely heavily on derivatives, primarily futures and options. Increased futures and options activity is exactly what bolsters CME Group and Cboe. When the market is highly active or experiencing turbulence, institutional investors and massive corporations need to manage their risk.
Just to clarify for our listeners, a put option is essentially an insurance policy that pays out if a stock price crashes.
What a spot on! And that leads to a sort of counterintuitive reality about these businesses.
How so?
Well, a massive pension fund might buy those put options to protect their portfolio against a sudden drop. Or a global airline might buy oil futures to lock in fuel prices for the next 2 years.
Right.
Every single one of those hedging strategies requires a derivative contract, and those contracts are traded on CME and Cboe. Intercontinental Exchange, ticker ICE, operates in a very similar capacity across various asset classes, too.
So they actually profit off of fear and panic. Like if the market crashes and volatility spikes, hedging and trading volumes just explode.
Exactly.
So CME Group and Cboe win whether the market is booming or crashing, just as long as people are making moves.
Precisely. The more uncertainty or movement there is in the global economy, the more these specific institutions thrive. They are immune to the direction of the market, but highly reliant on the velocity of the market.
Okay, so we have the investment banks advising on the deals and the exchanges collecting a toll on the volume and the data.
Right.
Let's transition to a slightly more complex category, because we are moving from pure transaction and exchange platforms to banks that operate multiple distinct business lines.
Yeah, this gets a little layered.
It really does. This brings us to winner group 3, diversified U.S. banks. The companies here are Bank of America, ticker BAC, Citigroup, ticker C, and Wells Fargo, ticker WFC.
These are the behemoths. They try to do a little bit of everything. Diversified banks can benefit from improved trading, corporate activity, loan growth, and fee income all at once.
Kind of sounds like a mega casino resort.
How do you mean?
Well, they don't just own the card tables on the trading floor. They own the hotel, which is consumer lending, and the high-end restaurants, which would be wealth management. So if nobody is gambling on Wall Street, they are still collecting room rates from Main Street.
That is a great way to visualize it. Because they operate across so many sectors, a boom in one area can lift their overall results. Bank of America and Citigroup, they lean heavily on their large capital markets operations.
Okay.
They have massive corporate treasury services that interact directly with their trading floors, capturing the exact same trends we saw driving JPMorgan Chase's record profit.
And Wells Fargo, ticker WFC, they operate a bit differently within this group, right? Because they don't really have the same Wall Street presence.
Correct. Wells Fargo is historically much more exposed to traditional lending, particularly residential mortgages and consumer banking rather than global capital markets.
Right.
However, in a strong economic environment where corporate financing is recovering, they still benefit from broad loan growth and a healthy consumer base.
Okay, wait, hold on a second.
What's up?
I'm looking at our outline here for the next segment, which is Loser Group 3, banks with rising costs. And I am seeing the exact same companies. Citigroup, ticker C, Wells Fargo, ticker WFC, and Bank of America, ticker BAC.
Yes.
You have to explain this contradiction to me. How can the exact same banks be clear winners, generating these massive revenues, but also sit right here on the losers list?
Yeah, it seems wild, right? But this is the ultimate double-edged sword of operating a complex financial institution. The answer basically comes down to the strict difference between top-line revenue and bottom-line profit.
Okay, break that down for me.
Well, the top line is the total amount of money coming in the door from all those trading fees, advisory roles, and loan interest. But strong revenue doesn't automatically produce stronger profit.
Because you have to pay for things.
Exactly. You have to subtract the expenses required to generate that revenue.
What exactly is driving those expenses so high that it lands these absolute banking giants on a losers list?
There are several persistent structural factors. First is compensation. When equity trading jumps 86%, the traders, quants, and executives executing those moves expect massive bonus payouts.
Oh, right. The talent doesn't come cheap.
Not at all. The cost of retaining top-tier talent on Wall Street is astronomical, and it eats directly into that revenue growth. Second is technology infrastructure.
Oh, bet.
Yeah. To compete in high-frequency trading and modernize their banking platforms, these institutions are spending billions, and I mean billions, on artificial intelligence, cloud computing migrations, and cybersecurity.
And I imagine the regulatory side isn't getting any cheaper either.
It isn't. That is the third factor. Compliance and restructuring. Navigating current regulatory environments requires literal armies of lawyers, auditors, and compliance officers.
Yeah.
So all of these escalating expenses ruthlessly reduce the benefit of that higher income.
Wow. So it is entirely possible for a bank to bring in record revenues, but actually see their profit margins shrink if their overhead and tech costs grow faster than their income.
Exactly. And this isn't just a problem for the three banks we just listed. Even JPMorgan Chase, despite reporting that breathtaking $21.2 billion profit, actually raised its expense outlook for the remainder of the year.
Wait, really? Even them?
Even them. That specific detail buried in the report proves that cost discipline is a persistent industry-wide challenge.
Right.
You can have the best trading quarter in history, but if your operating overhead is spiraling out of control, the broader market will punish your stock.
Man, that distinction between top-line illusion and bottom-line reality is just crucial.
It really is.
Now, let's move away from the high costs of these diversified banks and transition to institutions that lack a Wall Street trading buffer entirely. We are focusing purely on lending and consumer health now.
Okay.
Which brings us to loser group 1, regional banks. We are looking at KeyCorp, ticker KEY, Citizens Financial Group, ticker CFG, and Regions Financial, ticker RF.
Yeah, the regional banks are playing a completely different game than the Wall Street giants. Well, they lack exposure to global trading desks, tech IPOs, and large corporate mergers. When you hear about an 86% jump in equity trading, regional banks don't see a dime of that.
Nothing at all.
Nothing. Instead, their results depend strictly on traditional banking mechanics, deposit costs, local loan demand, and net interest margins.
Okay, let's really examine that term, net interest margin, because that is basically the lifeblood of a regional bank.
Hmm.
How does that dictate their success or failure in this specific environment?
Net interest margin is essentially the mathematical difference between the interest a bank earns on the loans it issues and the interest it pays out to customers on their deposits.
Right.
For regional banks, this spread is their primary profit engine. But in the current economic environment, everyday customers are demanding higher yields on their savings accounts.
Yeah, why wouldn't they?
Exactly. If they don't get 4% or 5% yield, they will just move their money to a money market fund. So the bank's deposit costs go up sharply just to keep cash in the vault.
And on the flip side, they are trying to lend that money out at an even higher rate to make a profit. But wait, if mortgage rates and business loan rates are hovering around 7% or 8%, loan demand cools off because borrowing costs are simply too high for the average person or small business.
That is exactly the mechanism. The bank cannot generate enough new interest income to offset the massive yields they are now paying their depositors.
So they just get crushed in the middle.
Yes, that net interest margin gets severely squeezed.
Wow. So if you are looking at your portfolio right now and you see banks like JPMorgan Chase generating record profits from fees and trading, your instinct might be to buy regional banks thinking, a rising tide lifts all boats.
Right, which is a common assumption.
But based on what you're saying, investors might just decide to ignore regional banks entirely and favor those fee-heavy giants.
That is the exact vulnerability for this group. If investors favor fee-heavy banks, these regional lenders could lag the wider financial sector simply because their business model doesn't allow them to participate in the capital markets boom.
They're just stuck on the sidelines.
They are tethered entirely to the traditional local lending cycle, which is currently under heavy pressure.
Which brings us to our final group, and perhaps the most vulnerable to the current macroeconomic conditions. Loser Group 2. Consumer credit specialists. We are discussing Capital One, ticker COF, Synchrony Financial, ticker SYF, and Ally Financial, ticker ALLY.
Yeah, these institutions specialize heavily in credit cards and auto finance, and because of that concentration, they are acutely sensitive to the financial health of the everyday consumer.
Right.
Right now, consumer lenders remain extremely vulnerable to rising delinquencies and charge-offs.
Let's define the mechanics of a charge-off, because that term gets thrown around a lot on financial television.
Sure. A charge-off happens when a bank officially deems a debt unlikely to ever be collected. They essentially give up and have to write it off their books as a total loss.
And why is that happening so much right now? I mean, because the Federal Reserve has kept borrowing costs elevated to fight inflation.
Right.
The interest rate on a standard credit card has skyrocketed well past 20%.
Exact.
So a consumer who could easily make minimum payments 2 years ago is now just drowning in compounding interest.
That is the core mechanism at play. There's mounting pressure on lower to middle income borrowers. When everyday essentials cost more and borrowing costs stay elevated, credit card balances grow rapidly.
And it isn't just credit cards either. Look at auto loans with a company like Ally Financial, ticker ALLY. What happens when a consumer buys a used car at the peak of the market? The value of that car plummets, but their high-interest loan remains the exact same.
Or they fall into negative equity.
Right.
If that consumer then faces a job loss or a medical emergency, the car gets repossessed. But the bank can only sell that repossessed car at auction for a fraction of the loan's value. The difference between what was owed and what the car sold for becomes a direct loss for the bank. That is the charge-off reality we are talking about.
I want you to mentally contrast the thriving IPO environment we discussed in Section 1 with the strict reality of those consumer loan loss provisions.
It's quite a picture.
Right. Because on one side of the street, we have corporations raising billions, Wall Street banks collecting massive advisory fees, and equity trading revenue jumping 86%.
Yeah.
On the exact opposite end of the spectrum, consumer credit specialists are hoarding cash, which obviously hits their profits immediately just to prepare for regular people defaulting on their car loans and credit cards. It highlights a very clear, stark divide in the current financial sector.
It is a perfect illustration of two entirely different economies operating simultaneously. Credit card and auto finance companies face compounding risk when borrowing costs stay high for extended periods.
Yeah.
Investors looking at this sector will watch those specific loan loss provisions very closely. If a company like Capital One, ticker COF, suddenly increases the amount of money they are setting aside for bad loans, it sends a clear, undeniable signal that the everyday consumer is struggling.
Regardless of how many celebratory IPOs are happening on Wall Street.
Exactly.
Well, we have covered a massive amount of ground today, looking at exactly how a record $21.2 billion profit at one bank exposes the underlying mechanics, strengths, and weaknesses of the entire financial ecosystem. Let's consolidate all of these details into a practical trading takeaway.
Okay, so the primary takeaway from the report is that the environment is broadly positive for the transaction winners. Specifically, JPMorgan Chase, ticker JPM, Goldman Sachs, ticker GS, Morgan Stanley, ticker MS, CME Group, ticker CME, and Intercontinental Exchange, ticker ICE.
Right.
The raw data confirms that trading, investment banking, and capital markets activity remain exceptionally strong. However, and this is key, we must factor in market expectations. Expectations are currently elevated across the board.
And when expectations are elevated to that degree, perfection essentially becomes the baseline, doesn't it?
Precisely. If these specific bank stocks fail to rally after reporting such impressive earnings, traders may conclude that the good news is already priced in.
Priced in, meaning the collective market already anticipated these record numbers months ago, and the current stock price already reflects that perfection.
Exactly.
So if a company just meets those sky-high expectations, there is no surprise left to drive the stock higher.
Exactly. And that tells us exactly what to monitor next.
Yeah.
You need to watch whether this strength actually spreads across other financial stocks or remains isolated at the very top of the food chain.
Right.
You need to watch if corporate deal activity continues into the next quarter. And crucially, based on our loser groups, you need to listen closely to management teams during their upcoming earnings calls.
You want to listen for the specific friction points we discussed. Are they warning about rising cloud computing and compliance expenses? Are they increasing their cash reserves for credit losses? Are they seeing weaker consumer demand in their internal credit card data?
Yeah, because those management warnings are the early indicators that the environment is turning, even if the headline numbers look flawless today.
I want to leave you with a final thought to mull over as you analyze these markets. We started by looking at a breathtaking number, a quarterly profit of $21.2 billion. But if a $21.2 billion profit is already fully priced in by the market, how do investors measure success when sheer perfection is the baseline expectation?
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.